Investing Basics: The Power of Dividends. Many investors seek out stocks with high dividends, but is this a mistake? High dividend-paying stocks tend to be more speculative. Lower-paying dividend stocks, like companies listed on the Dow Jones, have lower dividend yields. Let's use a very simple example to understand how a lower-paying dividend company, one that is a world dominator like Johnson & Johnson or Walmart, can give you safe, reliable returns for life. To keep this simple, let's say you bought a safe, reliable company for $10 a share that paid an annual dividend of 20 cents per share. This comes out to a 2% dividend. Now let's say you purchased $1,000 worth of stock, giving you 100 shares. Now let's fast forward in time and see what those numbers look like. Now remember, we are only buying companies that are safe, reliable, and have a history of never missing a dividend payment. Let's say the stock doubles every 10 years, yet pays out around the same dividend on a percentage basis. So in 10 years, the stock is valued at $20 per share, in 20 years, $40, and in 30 years, $80 per share. Same goes for the dividend. The dividend in 10 years is 40 cents per share, in 20 years, it is 80 cents per share, and in 30 years, it is $1.60 per share. This means that even though the dividend is only 2%, your actual return from just your dividends is 16% per year after 3 decades. Remember, your original investment was $1,000, giving you 100 shares. In 10 years, each share pays a dividend payment of 40 cents, which is a 4% return on your money. In 20 years, each share pays 80 cents, which is an 8% return. And in 30 years, each share pays out $1.60, which is only 2% for new investors buying an $80 stock. However, for your original $1,000 investment, you are now receiving a 16% annual dividend payment. The power of dividends is truly for the long-term investor. The most important factor is buying safe companies, ones that are never going away. To learn more about dividend stocks, visit everythinginvestments.com.